The year is 490 BC, and it's the Battle of Marathon. The Persians, the greatest army the world has ever seen at the time, versus the Greeks. Democracy versus dictatorship, and the greatest army the world had ever seen against the underdogs. But the Greeks had the Spartans, and against all odds they won. Interesting story. The messenger Philippides maybe, ran 26.2 miles from Marathon to Athens to declare that the Greeks had won. He then subsequently collapsed and died from the effort. But the modern day marathon distance race was born. In some contexts, this is called one of the most important battles the world had ever seen. Why is that? Because if the Persians had won and pushed on into Europe, the whole landscape and culture and fabric of what we know as Europe today could be totally different. Just as Marathon was a crucial moment in the history of Europe and the world, I believe we are approaching another crucial moment, not for empires and the history of the world as we know it, but for our own financial futures. And if you're not paying attention right now, then you could end up like our poor messenger mate that invented the marathon. Not quite that bad, but there you go. Today I'm going to show you one number and one number only. One number to rule them all. And when you understand when that number has appeared in history over the past 155 years, you'll want to keep watching. The number we're going to look at is the CAPE index, or the Shiller index. That's the cyclically adjusted price to earnings ratio. It basically looks at whether the stock market is cheap or expensive in relation to earnings over an average 10-year period. Simple terms. Why is it called the Shiller? The guy, don't know his first name, can't remember it. Shiller came up with the concept and won a Nobel Peace Prize for it. The long run average since 1881 has been about 17. Today, it changes daily, but as of recording, it sits at 42. And to give you some context, it's only been seen at this level or higher twice in history. Once was in 1929, months before the Great Depression, where it reached 31 before markets crashed 88%. The second time was just before the dot-com bubble in the late 90s, early 2000s, where it was at 44, so slightly higher than now, and there the Nasdaq crashed 77%. To give you a bit of context, before the GFC, global financial crisis of 2007, the number sat at 27, and we're at 42 now. So we're sitting at a reading that's only been seen twice in 155 years. Now, I'm not here to tell you markets are going to crash. I'm not a financial expert. This is not financial advice. It's just my opinion, having been doing some research on the data and the numbers myself over the past few weeks. Next then, we're going to look at some numbers for what the markets have done over the past 5 years. If you'd have had £50,000 in the market 5 years ago, we'll have a look at some scenarios on what might happen if and when potentially markets correct based on previous data that we saw with this Shiller index number. And then lastly, we'll look at a concept around a conversation I'm having with a lot of people at the moment, which is how do you crystallize or take those stock market gains you've received over the years, the past 5 years as an example in this case, and turn it into a concrete asset class that's non-correlated and that will not be impacted by a correction in the markets, aka, you guessed it, property. So I'll stick the data up on screen here for you on this one. If you had £50,000 and you stuck it in the stock market in 2021, you reinvested the earnings and the dividends, all of that sort of stuff, you'd probably have around 95 to 97,000. We'll call it £90,000 as a nice round number. 2021 was up almost 27%, so that would have taken your £50,000 to £63,000. Why was that? There's a lot of cheap money in COVID. People weren't spending on things because they couldn't go out the house, so people were investing using their spare cash for these sorts of things. 2022, we saw a 19% drop, so if you'd panicked then and sold, you would have lost 20% of the gain. 2023 was 24%, so you're back to 63,000. 2024 was 23%. Some of these numbers are mad, which would take you to 78%. And then 25 into 26 so far, we're at 14%, which will give you, say, 90 plus or minus. So you've turned your £50,000 into 90, and I know a lot of people that have made a lot of good money in the stock markets over the past 5 years or even longer. Let's have a look at some scenarios then where if what the CAPE index is suggesting markets will correct, what would happen to that £90,000? Because at a CAPE or Shiller of 42, we are reaching a record number only seen once before. And I hear some people say, oh, it's different this time, AI. It's never different. If you read any of the Morgan Housel books, same as ever, Psychology of Money, The Art of Spending Money, that is a common theme throughout all of them. We've got three scenarios then. We've got a mild correction, which we're saying is 40%, which is what we saw in the GFC 2007 when CAPE was at 27. We've got a repeat of the dot-com correction. We'll use 55% for that, where CAPE was at 44, the highest we've ever seen it. And then we've got a extreme correction, which is the Great Depression, CAPE at 31, over 80% fall in markets. And again, not financial advice, just something I've put together based on the research. In a mild correction, your 90,000 becomes 54,000, basically wiping out your entire 5-year gain. In a repeat of the dot-com bubble correction, it's down to 40,000, so you've lost 10. And in a repeat of the Great Depression, which I hope does not happen, you're down to £18,000 or £72,000 loss, which then brings up the question, how can you protect some of those gains? And I would caveat that with the fact that stock markets do always recover and they always come back to reach new all-time highs. So if that was to happen, you simply just sit on it and hold, and I would say invest more, because you'd be buying at great low value and wait for the markets to come back, which they will. How then could you take some of that gain and put it into an asset that is not going to be impacted and drop by 40 to 80% in value if markets crash? What we would call, or I would call, a non-correlated asset class. So that could be, for example, gold. When markets are falling, people are scared, they buy gold because it's a physical safe haven asset. Property has similar properties. And I know what a lot of you are probably thinking, it's property goes up 4 to 5% a year. If you're lucky, you get a return in terms of the income from the tenant at 4, 5, 6%, which is nowhere near, doesn't touch what markets are doing, especially when markets are doing 18 to 20 odd percent. Now that is true on the headline figures, but it does not take into account a property investor's secret weapon and what we should all be using, which is leverage, aka a mortgage. Now the figures will look totally different with a mortgage, so let's talk through them. I've got two scenarios here I'm going to go through. It's using £50,000 and deploying that £50,000 into the stock markets versus using that £50,000 as a 25% deposit on a property and then getting a mortgage or using leverage on the other 75. What do the numbers really look like, and are they that different? So the stock market, 50,000 deployed, you get 50,000 allocated. In an 80% bull run, as we've seen, I don't know if it's a bull run, I guess it might be, as we've seen over the past 5 years, that's a £40,000 gain or an 80% return on your money. 16% per annum, but fully invested in stocks and shares. Now with property, £50,000 down, you take a 75% mortgage on the other £150,000, so you now control an asset at £200,000. 5-year growth rate, not 80%. If you look at what Savills are saying, their most recent house price report, they're saying 22.2%, which on your £200,000 is £44,000, which as a percentage of the actual cash you've deployed, i.e. your £50,000, £44,000 gain, is actually an 88% increase. And that's just looking at the capital appreciation, not the income as well. Again, simplified, which gives you 17.6% per annum, plus exposure to a non-correlated asset class, i.e. not linked to stocks and shares. Lastly, in addition to that, you've got your rent on top of that. If you're taking a 6% yield, you'd have £12,000 per annum, £1,000 per month, which again, 6%, but it would increase because it's leveraged. So when I'm talking about crystallizing gains, what do I mean? I'm talking about, and no one can predict when the markets will correct, if they will correct. Maybe they'll keep going, maybe it'll be next week, next month, next year, 2 years, who knows. But it's taking some of that gain, locking it in and putting it into something else that's not going to drop with the markets. What should you do then if you are 100% in stocks and shares, or you are looking to allocate and spread and create a bit more diversification or more baskets with eggs in? I certainly don't think you should be panic selling your stocks and shares. And frankly, if you're comfortable with, if you've got a long time horizon, say you're in your 20s, your 30s, your 40s, and you don't plan to be using or accessing that cash for 5, 10, 15, 20 years, then, and you're happy with it going down and you don't check it, then you can leave it. What I'm seeing is people looking at their portfolios and saying, okay, I've done exceptionally well here over the past 5 years or more. How can I put myself in a more solid situation by actually taking some of that gain and putting it somewhere else that will allow my portfolio to keep growing and to keep getting those high double-digit returns regardless of what happens with the stock markets. There are many different ways to do that. The way I like, because it's the way I know, is property. Cast your mind back to the start of this when we talked about the messenger that ran 26 miles and created the marathon. He delivered the message changed history, created a race, and then dropped dead. And he couldn't enjoy the victory or his victory because he gave everything in one sprint, although it was a marathon, not a sprint, and then couldn't enjoy it. So don't be like the messenger with your portfolio. Don't hang on and redline at the end looking for maximum gains when you could also have high downside. If history repeats itself, which the numbers suggest they might, then it will set you back a fair way. Stock markets will come back, they always do, but when it comes to wealth creation, you need to be in the game to play it, and wiping yourself out with some short-term losses from being over-aggressive is not the way to win long-term. It's a marathon, not a sprint, so pace yourself. Everything I've shared today is my own perspective and opinion, not financial advice. I'm a sucker for trends and numbers and data, and simply looking at the data, you'll be able to find this information yourself and make your own mind up based on that. If you'd like to explore or understand how leverage works in property in more detail and what the real returns look like when you do that, hit the link below and drop your email in, and I'll send you an email, which is a newsletter of mine I put out a few weeks ago that goes into detail on how you can use leverage and what it looks like.